Hey guys, I'm Jen. Thank you so much for joining us on another Blockchain Banter Unfiltered. I have an amazing panel here today. A couple from last week. We've got some new additions, new guests. I want to go around, ask everyone if they would please introduce themselves, introduce their projects, a little bit about what they do within the industry. Mark, if I may pass the mic over to you, have you start us off, that would be so wonderful.
Certainly. My name is Mark Richardson. I've been working for Bancor Protocol, as a contractor since 2021, and as just a volunteer community member since 2020. I started off as a researcher, and then became the head of research, and now the project lead as of October of 2022. Bancor is goes back a long way. But it was essentially the project that brought the concept of automatic market making to Ethereum back in 2017. And its mission statement hasn't changed at all since then. Its objective is still to create exchange primitives so that cryptocurrencies can learn their value and be a part of the financial fabric of smart contract enabled blockchains.
Thank you so much. Matt, welcome back.
Thank you. Yeah, so I'm Matt.
Yeah.
I'm co-founder and head of research at Odos. So at Odos, we aggregate all liquidity on chain, and we then find the best route through that liquidity for any two digital assets on any given chain, or any group of digital assets to digital assets. You can do multi to multi as well.
Thanks so much. I forget sometimes I'm muted. Ceazor, may I pass it over to you?
Sure. I'm Ceazor of Ceazor Snack Sandwich, a DeFi enthusiast, educator. I use all the protocols here that are talking. I love them all, except maybe Aori. I haven't had a chance to play with anything there, but I think that's because nobody has, right?
Yes.
Yeah, exactly.
Except for me. I'm hogging it all to myself.
Yeah, exactly. So yeah, that's pretty much me.
Thanks, Ceazor. Speaking of Aori, Josh, maybe you want to pick that up.
Joshua Baker, CEO of Aori. Aori is a high frequency intent, matching layer between, a lot of different counterparties like solvers, market makers, DeFi protocols looking for optimal routing. Heavily inspired by CowSwap on the call. So, yeah.
Which brings me to Alex. Anybody who listened in last week, we were talking quite a bit about CowSwap, and it worked out perfectly because Alex was already set to join us for kind of a different topic, but it worked out so well. Alex, welcome to the call. Thank you so much for joining us. Would you mind introducing yourself and CowSwap?
Yeah, thank you for having me. So I'm Alex, work as product marketing in CowDAO, Cow Protocol / CowSwap. And basically, Cow Protocol is the first intent-based DEX in Ethereum that rolled out in 2021, at least the beta. And yeah, the whole idea is similar to an AMM or an aggregator, but instead of just having the users execute the transactions, users sign an intent to trade that is then passed on to a network of solvers who compete to find the most optimal route for those intents.
Awesome. Thank you. And again, good to have you. So, of course, Josh, last week, I always come in here with a topic that I kind of want to discuss, or something that I see being discussed on Twitter, or, something that I think we can really debate. But I always encourage you guys also, if there's something specific that you want to talk about, to please obviously raise it, right? And so, Josh, you kind of last week, you were like, I want to talk about the future of Ethereum. I want to talk about this. I really want to talk about this. And we started, right? But it was kind of more towards the end of the call. So maybe we can pick back up where we left off last week, or even kind of do a recap of it, because like I said, CowSwap was a big part of that discussion and Alex wasn't here for it. So would you mind maybe just kind of picking back up and rewinding a little bit for us?
Yeah, I guess we went in a lot of directions on the last call, but like generally speaking, and there's a couple of directions I think are worth really exploring now that we have Alex on the call. And yeah, it would be really good to get Matt and Mark's opinions on as well. But we were talking a lot about like how Odos and solvers in general are dealing with like the rapid rise of like intent-based architectures and intent-based like protocols and platforms. And like, yeah, there's quite a lot of directions that it seems like solvers are being pulled in, whether it's like, hyper optimization on like one particular facet. Like I know I was talking to a solver the other day that like, writes all of their program. They've been like writing a version of they rewrote Uniswap's V2s and V3s math in C so that they could like, be several milliseconds faster at solving with UniV2 and UniV3 math than every other solver, like, really like, hyper specific things like that. And then you have other solvers that are like, we're going to go so long tail, we're going to integrate every single source of liquidity humanly possible and how. And that was just to kind of handle CowSwap, which is like, on its face, like, a relatively simple like auction system, and kind of how winning order flow through that. So given that like, now we're starting to see things like Anoma, Suave that are like, okay, now you can have all these complicated, crazy routes for solutions where you're like, I want to open a loan position or I want to open a futures position or anything like that. We talked a little bit about this last time, but it's like, do you see solvers trying to continue to generalize or continue to, get hyper specific in their niches that they're the best at? I think that's probably like a good way to start. Yeah, Alex, Matt, Mark, if you guys wanted to jump in, just general, recap of like the end of the last call.
That's a lot of topics from last call.
Oh, hey, yeah, we talked for a while, so.
I mean, from my point of view, and maybe this is from the product side instead of from the solver, so it's difficult to speak, as their voice in a sense. But from the product, I do think that generalization is coming because more and more solvers, or better than solvers, more and more users are demanding this abstraction of, hey, I just want to simply like go from my USDC or my stablecoin or whatever coin I have to this end position that I want to achieve, right? So definitely solvers are going to be more generic, but at the same time, we're going to see specializations, right? You see already today that there are solvers that can only handle certain abstractions. And for example, in those particular abstractions, they're kind of the kings of the competition. Whereas maybe in the regular like routing competition, they might not be as good. So I think within the generalization of the kind of abstraction of the transaction per se, there's still going to be specialization of, okay, I'm particularly a better solver at this specific type of vaults or this specific type of lending positions, etc.
Yeah, that makes sense. Yeah. Yeah, Matt, I didn't know if you had any extra comments, or Mark as well on that before I have a couple more questions as well.
I have something to add to it. There's also the factor of like protocols themselves becoming solvers, like Yearn Finance. So obviously they're going to specialize in having people deposit into Yearn and exit out of Yearn vaults. And then they also the solver doesn't have, a generalized solver doesn't have to keep up with like contract updates, changes, and stuff like that. That Yearn themselves will manage that and be able to make sure that CowSwap can route through their contracts without any issues.
Yeah, only like the increasing specialization versus generalization. I don't think that we should necessarily expect a trend in either one of these directions necessarily. But maybe the variety of different like solving types is likely to continue to grow. So like as Alex pointed out, I think that it's very, very likely that there will be specific, like either specific tokens, token pairs, or even preferred DeFi protocols that some solvers will choose to interact with, and as they occupy that niche, it will open up others. And I think it's going to be normal, thermodynamic equilibrium as anything else in financial markets. If there is someone who's not paying attention to, some long tail token, and there's sufficient demand from the users of something like Cal protocol, to trade with that token, there will be an opportunity there, and someone will try to fill it. And those people that fill, like, for example, something like the Pepe token on launch day, or the day after launch day, you would consider that like a hyper specialized solver, right? If they're dealing exclusively with these kinds of pairs. But that doesn't mean that the more general, the more general solvers are sacrificed. So I think that there will always be competition, and it's not necessarily true that the specialists are going to outperform the generalists all the time. And I think that there will always be a mixture of them, and I think that that's sort of we should expect to see like maybe an improvement in the density or the granularity of the relative specialization. But I don't expect that we'll ever get to a point where we can say, look at how specialized everything has become, or look at how general everything has become. I think we will always have both.
Yeah, and I guess for Odos, at least, I can speak for Odos, we sort of definitely look at it from the generalist perspective, I would say. So our specialty is routing through the dexes themselves and being able to consider all possibilities there. So integrating every dex and liquidity source possible is definitely a big part of it. But then also expanding to things like directly depositing and withdrawing from yield optimizers or lending protocols. Really anything that's tokenized is also a part of, I would say, what we want to continue to expand into, so that it really is routing between any digital asset that you might want to move between on-chain.
Yeah, I guess while we have Alex here, one question, like this is a little bit of a pivot towards talking about what CowSwap's working on, but I know the CowAMM, the FMAMM paper came out. I guess, it seems like you guys are kind of taking a really unique approach in terms of similar to like, Carbon, in terms of optimizing the underlying AMM versus trying to move logic of the AMM off chain. And so I guess like one thing I'd love to know about is like, why not stick with like an auction model? Like I know there are like a couple protocols that are like, taking a lot of inspiration from you guys and basically auctioning off the right to arbitrage a pool. I guess I'm curious about like, the design decisions between like, how you guys have looked at architecting the new CowAMM versus, the existing CowSwap, infrastructure.
Yeah, I mean, it is an auction. It's just within the CowSwap auction, right? Basically, like the right to ARB the AMM is only possible for the solvers. And then because of the competition, this is how the LPs benefits, because whoever wins within this arbitrage competition, right, from the solvers is the one that is actually closest to the true market price instead of the stale price. So this is the cool thing that and how the whole LBR protection comes from, because right now and most likely in the future, CowAMM liquidity is only going to be tappable by the solvers or by CowSwap kind of users through the batch auction competition.
Gotcha. Makes sense. I don't know if anybody else has gotten a chance to check out the CowAMM paper, but very cool paper.
Yeah, and if you want to test it, it's already live in a proof of concept style with your safe. So there's a safe app called CowAMM Deployer that makes it very easy to deploy.
Oh, very cool, very cool.
Yeah, the only thing is still a proof of concept. So liquidity is single-handed. Like you can uncurve liquidity, so it's per kind of deployment. But we are actually working on future versions that are gonna be live sometime. So.
Nice. That's very cool. Very cool. I don't know if anybody else had any questions. Jump in. Feel free, please.
I'll give it a second in case anybody else has any questions. But Josh, you brought something up. You were saying, well, first, does anybody else have any other questions or like comments? I know that Josh brought up something that I wanted to touch on. Okay, you were saying that CowSwap is doing something kind of similar to what Carbon DeFi is doing in terms of like the AMM shift, right? We've spoken about this before. Why the auction sort of model? Like we see, Josh, you're kind of going like limit order protocol, right? Mark, you guys, go ahead. Sorry, am I right in saying that? I mean,
no,
Aori is a limit order.
the main difference between like the way Aori is structured and CowSwap is just that like we kind of look at, well, number one, we tap into CowSwap liquidity, so that's definitely something that we've put a lot of thought into. But number two is like, rather than a binding auction mechanism, whenever a user signs an intent, we allow it to be more like an RFQ where they say, I'd like to sell 100 USDC, and every solver can then fill the order book with public quotes that are them attempting to fill it, or provide the best route possible. And then they then can choose optionally if they wish to fill it. So it's less binding, but it's a different design choice, not that it's better or worse in any way.
Right. And it seems all three of you have kind of shifted from this AMM, like at its core, right, for what it was, into these different sorts of models, right? So we're talking about the like CowSwap being, well, this new model being like an auction, right? Josh, you just explained yours. Mark, yours is even a little bit different still. Like, do we see more of this shift happening even more so? Do you think, like, we're talking about the future of Ethereum, right? Like, let's talk about like what we see for the future of DEXs, not even necessarily on Ethereum, but just in general. You know, Uniswap has always kind of been that like industry leader, and they're doing an AMM still with these hooks and things like that. Like, what do you guys feel on where this is actually going in its, direction for Ethereum?
Yeah, I think so. There's a little bit to unpack there. I think that it's first, let's just acknowledge that from the user perspective, an AMM is a very bad idea, right? From like the perspective of someone who is providing liquidity to the underlying financial instrument, it's a very difficult thing to make financially performant. I think that if you are in the shoes of someone who has, for example, seeded, raised funds with a token pre-sale, maybe with some private sale and other token distributions and that sort of thing, and you're under a lot of pressure to then create a liquid market for it, something like an AMM is very convenient. But it's not because you think that it's going to make you a lot of money, but it's because it does actually allow people to interact with a relatively good approximation for what a liquid marketplace would look like. And that really is the AMM superpower. But from the perspective of someone who's actually buying a financial instrument, right? And I do consider liquidity provision to be like buying a short straddle, right? This is the underlying financial instrument that's there. If you ask people, what they're buying, or if you explained an AMM in terms of what a short straddle is, they probably wouldn't do it, right? Like you're making the bet that there's going to be the price is basically going to go nowhere, right? You have to be neither bullish nor bearish on either token, and you're hoping that their price relative to each other basically doesn't move. And unlike an actual short straddle where you can sell that option and earn a consistent premium, on the AMM, the return profile is actually volume dependent on that trade. So it's like, in a way, it's a short straddle, but much worse. Because you actually are, its performance is contingent on, some baseline, fine structure volatility. And this is the bet that you're making. I think that the reason why we're seeing this drift away from the AMM design is because it's no longer the token issuers who are using them. Right. Remember back in the day, the idea was that the AMM liquidity providers would be exclusively people that launched the token. But then the shift during DeFi summer to saying no, it's now the community's responsibility to bootstrap liquidity and keep the market liquid for us. That I think it's now a natural progression back towards these kinds of decades old CeFi primitives. Because at the end of the day, the person who is providing liquidity to these things, they are trading those tokens, and they are going to want to trade those tokens as a free agent, right? As someone who is able to exert some level of influence or control over how their tokens are traded and at what prices. And this is what's been lacking, right? Rather than trying to make it never made sense to try and make AMMs attractive to normal people. That was just a big mistake that I think that the industry went through. And I think that now, as is being, I think demonstrably adhered to by the rest of the industry, we're now finding that, okay, if you want people to be happy using these protocols, then we have to give back to them, that agency that was taken away, when the AMM was introduced. And that's why like these things are all trending that same direction, is that the users have to feel like they know what they're doing and that the protocol does what they want it to do. And there's only
So
really
when
one
you
way
say
to do that.
users, Mark, when you say users, you're speaking about liquidity providers.
Well, yeah,
Not-
I mean,
not
I hate
the-
the term. I hate the term liquidity provider. I think that in general, before blockchains, you would call a liquidity provider someone who is literally just keeping the market liquid, right? Someone who does line the book on either side. And they would be incentivized either by the government or by the exchange and so on to do that, right? That's a professional job. It used to be the job of professional market makers. I think liquidity provision in a DeFi context, like technically it does mean the same thing if you're providing liquidity to an AMM, but it's not the way that it's sold, right? It's sold as but you're going to earn fees and all this other bullshit. It's actually, liquidity provision should be very specific, like should describe something very specific. And if you have, if you interview enough people that self-identify as liquidity providers, you will learn very quickly that they all disagree on what it is that they're doing. I prefer the term trader, right? People that are, interacting with these protocols are subscribing to or executing a very specific trading strategy. And so, yeah, I prefer the term trader to liquidity provider. I think that most, even if liquidity providers don't self-identify that way, it's still a much more helpful way to describe them and categorize what they're doing.
It's interesting. I would think that a lot of liquidity providers would not see themselves as traders, despite the fact that they're not just simply providing liquidity, that their tokens are being traded. Alex or Josh, I want to ask you guys, and Matt and Ceazor, feel free to jump in here also, right? We're talking about this sort of model shift. I think it was not even necessarily the fact that it wasn't meant to be a financial instrument, but I think also some of the risks of providing liquidity have kind of been unearthed in the last, year or two. And I think this is where a lot of the MEV sort of sandwich attacks and things like that really come into play. And I know that a couple of you guys have been working on that. Maybe I can pass it over to Alex.
Yeah.
You can.
So
I mean, I'm just kind of curious, like you guys have taken this and created this new model kind of built on the AMM, right?
Yeah, so I think I agree with Mark, because ultimately when you provide liquidity, you're just executing a strategy, and people tend to say impermanent loss, and it's like, well, it's just a bad trade, right? Your options were either to just hold or put it in here and expect to have more. And this is why, at least for KYMM, the way we see it is that when you're depositing liquidity, you're effectively running just a passive rebalancing strategy. You just have the AMM, it's always going to keep 50-50, and it's automatically always going to hold those values in USD terms in reference to the pool that you actually put for reference. But then the issues around MEV have risen because of the maturity. Well, I don't know if we're fully a mature market, but there's more players and more solutions in the system, and of course, with the rise of the amount of money that is being transacted, then there's a lot of smart people out there that are saying, well, there are these opportunities. But mainly, and this is the reason why we actually launched the KYMM, was that we always talk about doing everything on chain, and the ultimate goal, right, is to have price discovery happen on chain. But this is far from true. Right now, most of this is happening on centralized venues, and then this creates the ultimate arbitrage because they are out of sync, right? In a centralized exchange, price move in milliseconds, whether it's on Uniswap or any other AMM, price move every 12 seconds. And this is because there's still not enough liquidity on chain. So until there are more and more solutions that kind of, I guess, promote the liquidity provisioning or liquidity strategy provisioning side of things, we're just not going to get rid of this. So that's why, we launched this solution, because we hope to attract these bigger players that actually are fully aware of their strategies, that, hey, now you can actually safely put the liquidity on here and just, make your bet that at least this is going to rebalance according to the market.
Have people experimented, or I'm not sure if it's possible. I'm familiar with the majority of cow swap routing being from, guys like Odos and whatnot, but have people tried or experimented with using private liquidity? I know private liquidity is very common among like other auction mechanisms, other option like protocols and whatnot, but like I'm curious, like if it's, if you guys have seen it, enter cow swap at all. I was looking at order flow.
What do you mean by private liquidity?
Alex, if you want to explain that one.
So basically, like a solver can find liquidity for settling the intents in the batch in various ways, right? You can either go on chain. Well, I guess more ways. You can either just match the intents together. So when there's like a pure counterparty to counterparty overlap, like if Jen, you're selling and I'm buying ETH USDC, then we are matched. Or you can find your private liquidity either via centralized exchange, or, which is the case for some solvers that are connected to market makers, that then it sort of becomes like RFQ system. Like, hey, we have this trade from CowSwap that is asking for this price. Do you want in or do you want out? And like we have seen solvers actually like fully integrated in market makers, and then solvers actually leveraging this sort of different venues for RFQs.
Because I was wondering, like in theory, there might be a really cool way to provide liquidity via, I guess pools that are, effectively represented in CowSwap, right, as private liquidity. But like, none of the actual trading logic is on chain. That might be something really.
You wouldn't need to. You wouldn't even need to, right? Because I think from the perspective of the protocol, all they care is that, like the only thing that matters is that the conditions of the trade are met.
Yeah.
Right. Yeah. The solver doesn't. The solver could trade with their own private wallet, right? Like they don't need.
Happens more often than you think.
Yeah, exactly.
But
this
yes.
is very, very. Go ahead, Alex.
Yes, sorry for interrupting. Yes and no, because then so basically the whole thing is ranked through a objecting function to maximize surplus, and I know certain types of orders kind of qualify a bit less than a normal order. Sure. Because if not, this is the thing. Like if you trade with your own wallet, it's easier to kind of gain the option.
Sure. Yeah, I'm oversimplifying. I just mean that like if there's an intent that someone wants to receive a certain price threshold or greater, a solver could easily have and I imagine that they would probably deploy their own smart contract to do this, just to keep the funds probably under multi-sig or something. But there's nothing stopping, and in fact a lot of arbitrageurs, and I consider the solvers to be a type of arbitrageur, already do this. The funds are in a dedicated smart contract that works exactly like a private liquidity pool. It's just that it's it doesn't have you can't trade with it. Only the solver can trade with it, and this is a totally normal. There's nothing weird or wrong or unexpected, I think, about that arrangement.
Mark, you said that you consider the solver to be a type of arbitrageur. You guys also? They are?
It's always arbitrage, and that's not a bad. Like, I don't know why arbitrage is such a dirty word, but yeah, like
Alex, I'm curious. Alex, Matt, Ceazor, we've talked about arbitrage before. I know that Josh and Mark kind of see this the same way. Do you guys see arbitrage as this dirty word?
Hey, apologies, I have to run. It is a pleasure to everybody.
Oh, okay. We'll talk to you soon. Thanks so much.
And thanks so much, Alex. Thanks, Matt. Thanks, everybody. Thanks, Ceazor. Mark.
Bye. It's a dirty word, and yes and no.
Is it a dirty word? Yeah.
Yeah. Like from the true market perspective, no, because arbitrage is what brings efficiency to the markets. The problem is what is happening in Ethereum that's labeled, or most of the arbitrage that's labeled as arbitrage is not true arbitrage. It's just basically people manipulating AMMs to create arbitrage. So then
Okay.
there is a point that, like, sure, of course, you're closing efficiencies, and if these gaps exist, you can consider yourself kind of bringing the market to efficiency. But
Alex,
it's
can I get you
yeah.
to clarify something? When you say like manipulating the AMMs to create arbitrage, are you referring to like sandwich attacks and that kind of like malicious?
Yeah, exactly.
Yeah, okay, fine. That's well noted.
Because it's more like this is not, you're kind of just because of the way that the blockchain set up transactions, you're just playing around to create an arbitrage opportunity for yourself.
Yeah.
It's not that you're mega smart.
I agree.
Well, I mean, you are mega smart because you run an MEV bot, and that's fairly complicated.
I think that we need to like we shouldn't conflate arbitrage and sandwich attacks. I think sandwich attacks have much more in common with something like order spoofing, or like marking the close or something like that in a toxic flow context. Like it's literally toxic flow. Whereas normal arbitrage is, it's like I consider it to be just like a normal operation. So for example, like one of the things that you mentioned earlier on in this call is the fact that Ethereum has a 12-second lag time means that there's like an enormous amount of like top of the block arbitrage opportunity between like a decentralized exchange and a centralized exchange. No doubt about that. But the question is, who should be upset about it? Because all of the LPs on Ethereum are always like putting their hand up saying, hey, we're being, exploited by this trade. But actually, it's just as legitimate to say that the traders on the centralized exchanges are getting fucked, right? Like they're paying the higher prices or the worse prices when they could have traded directly on Ethereum. And they can't both be right. And the example I usually go with, yeah, right. The example I usually go with is like if I sell my car to my friend for $1,000, and he turns around and sells it to his friend for $2,000, his friend is going to be upset because he paid a higher price than I sold it for, but I'm upset because I could have charged more. It's just disagreement. And it's not like the friend that facilitated this trade in the middle that made $1,000 profit has taken $1,000 from either one of us.
Yeah,
we were both wrong.
The thing is that but in your example, you're sharing the infrastructure. And in here, you have this kind of disconnected infrastructure. So this is why you have this clash.
Wait, Mark, hold on. Let me finish.
I agree.
Let me finish 1 second.
Oh, sorry.
No. That I was going to say, like, you have this clash and the example holds true. The only thing is that, at least the way I see it, that especially the people working in DeFi, you sort of working here, not just to create these, I want to be right, I want to be wrong, or like, kind of create this arbitrage, but to move all the other side of the infrastructure to your side, which is ultimately like the whole promise of Ethereum or crypto, DeFi, smart contracts, and so on. So this is why I lean towards the LP being more in the right side, because not that we want to get rid of centralized exchanges, but we want to get rid of as much activity happening in these closed systems towards the more open ones.
Yeah, no,
I want to make sure that Matt and Ceazor will jump in here also.
Yeah, sorry.
No, that's okay. No, I just want to, like, you guys have something you want to add to the conversation, please do. Just because the two of them are going back and forth doesn't mean like, I want to hear from you still. I'm sure, we all do. So please feel free to jump in here where you'd like.
I always try to consider arbitrage in the sense of who is the actual beneficiary. Like with sandwich attacks, or even with like arbitrage bots that are just looking at liquidity pools and arbing them, which is very competitive, but it's generally an individual or some small entity. Whereas like arbitrage via solvers or via DEX aggregators, generally the users are the beneficiaries of that arbitrage opportunity. So I try to look at it morally in that sense, like who should be getting that value, like not the makers, in the sense like, because the makers get nothing unless there are takers. So we should be, encouraging the takers to take. So I think that they should be the ones who get the arbitrage opportunities that are out there. But that's kind of like, you can also kind of think, oh, we need to incentivize makers, because if there are no makers, then the takers can't take, right? So it's a very like a moral case, but there is those people who are neither makers nor takers, and they are taking the arbitrage opportunities. So those are the people I feel that are kind of like, you can almost term them as parasitic, like on the markets.
Aren't arbitrageurs just takers though, Ceazor?
But when I say takers, I mean like they're not actual takers in the sense of like they want to buy a token. They're going to be like, most of the arbitrage bots are sitting in USDC or ETH, and they're just gonna buy and then immediately sell it again, right? So that's not really like a taker who's like, hey, I want to buy some ETH because, you know, I want to get into the market.
So their intention is where it comes in.
Yeah. So that's kind of the way I kind of think about like different kind of arbitrageurs or arbitrage systems out there. There is the moral aspect of it. Like, of course, we need it, and the markets definitely needed arbitrage to happen. But if we can encourage arbitrage value to be given to the actual users who are not just sitting there waiting for like misbalance and then rebalancing.
Matt, I'm curious what you think about this, because last week we were talking about how, you know, you didn't create this full-on arbitrage system, right? Framework, but as an aggregator, you do arbitrage, right? And Mark, I want to hear what you have to say about this as well, because I know that you have the arb fast lane. Not to get too far off of what you and Alex were talking about, but it's all kind of intertwined, right? This arbitrage and the sandwich attacks and things. So, Matt, do you want to add to this at all? I want to give you the opportunity to unmute and kind of speak your piece here.
Yeah, of course. I think what how Ceazor put it is actually a good perspective, where like we're still, when we're routing through exchanges, in many ways we are doing arbitrage, but that arbitrage profit benefit is going back to the end user making the trade. And in many ways, that's because in many cases, it's because the user made it possible by actually wanting to move between assets. Because as I mentioned last week, in many cases, the arbitrage being extracted is not arbitrage that's profitable to extract on its own. Because if you're making like a round trip back to an asset, you essentially have different considerations than when you say, I want to go between these two assets and I'm building in some sort of gas cost that's going to take. And now you're taking the best price on all the exchanges, and you're extracting some arbitrage there, but it's definitely different, I would say, than someone just trying to extract profit from the market in arbitrage between different venues.
Alex or Mark, you guys want to add here? Good. Mark?
I have a question for CowSwap, if I can. If
go
nobody
for it.
wants
Yes,
to go.
Ceazor, go.
Yeah, I got two questions for you actually. I haven't read the white paper, but a friend of mine, an octopus friend of mine, he mentioned to me that you guys quote the same price per block. So what this, like in my understanding of this, is it absolutely eliminates the possibility of sandwich attacks. Because, you know, if the first trade in this block and the last trade in this block all get the same price on your AMA, is this correct?
Yeah, so the whole thing is because it goes through the CowSwap batch, the uniform clearing price kind of enforcement that it's applied to the solver competition does apply. So therefore, like if the rebalancing trade for ETH/USDC is also in the same batch that another trade at ETH/USDC, then they're all going to get the same clearing price.
So yeah, it is correct then. Like you can't sandwich if the swap is going completely through that pool, then it's impossible to sandwich it, right? Yeah. Okay. The other thing,
I would say you can't, like, one person in the batch can't sandwich someone else in the batch, but someone outside of the batch could technically still sandwich the solver solution.
The entire settlement, but it gets quite hard.
Yeah. I mean, it's
so
hard to
inside of the batch, inside can't do it. Outside in can.
Oh, I see. So you're,
is that right?
So the CowSwap batch is put into a block, and then someone could sandwich that CowSwap batch if the block has enough space for sandwiching.
And like generally solvers on Ethereum should be sending direct to block builders and like avoiding that possibility. But if a sandwicher does get access to the batch, they can potentially.
True, actually, you bring a good point, because all the solvers are using MVB blocker. Then this is not possible, because there's no, unless something within MVB blocker actually breaks and the transaction leaks or there's a reorg. But this is like nothing that we can do. If there's a reorg, then it is not possible at all to sandwich this.
Right.
Okay, so my second question is kind of both for Odos and CowSwap. If you look at the user experience of these two protocols, basically what Odos will do for me is, as a user, I will say I want to trade this token for that token, or multi-token in your case, but this token for that token, and you're going to quote me a price and say, oh, we're going to give you at least this. Do you like it? And then I'm going to say yes, pay the gas, and then it's going to happen. Whereas on CowSwap, I'm going to do it's very similar. I'm going to say, I want to trade this for that. You're going to quote me a minimum, and then you guys are going to extract the gas. I don't have to pay that gas. You're going to take it out of the swap somehow. So the solver is going to sell some of the revenue from the arbitrage or something to pay that gas. So I'm wondering why CowSwap does it that way. Why have you extracted away the gas, and then why hasn't Odos extracted away this gas?
Yeah, so I guess on Odos' side, I'll say that we likely will at some point at least provide an option. I think so essentially what's being talked about here is like we'll call it the transaction-based method of transacting and the intent-based, right? And I think the intent-based often has better UX, but it's less flexible, right? So there's a lot of things you can do with the current way Odos works, where you basically just ask for a quote and you get a blob of call data, and you can do whatever you want with that, right? You can just execute it yourself. You can use that from another smart contract in some more complex action with rebalancing some other protocol, or swapping collateral behind the scenes if you're Aave. So it's a lot more flexible, but if you're just trying to do a swap, the UX is definitely potentially worse, right? So I think having that as an option, but also having an option where it is intent-based and someone else is handling the gas payment and actually landing it on chain, because that's the part you're sort of extracting away. I think that's very valuable, but it's sort of one, depending on your use case, it's which one you pick.
Yeah, so for us, the idea was the UX, right? Because it's kind of cumbersome to be forced to have ETH. And until we had gasless approvals, of course, you needed ETH in your wallet for the approval. But now with like those tokens that have permittable functions, then you can completely just send money to whoever new of your friends is joining crypto, and they can actually try CowSwap without needing any ETH. And this is quite a breakthrough, but kind of a nice UX experience. And the whole idea is that the gas fee is already accounted for the price that you're giving. So then the solver knows that they actually need to take care within the quote that they give you, that the current gas fees, in order to execute the settlement.
So the quote that they receive includes, that is the minimum that they'll receive. It's not the minimum minus gas fees.
Exactly.
Okay. Mark, what about on Carbon DeFi? We're making our rounds here. Let's just go in a full circle, or a triangle, I guess.
What do you mean?
Well, I mean, if you're placing, like if you're making a trade, Ceazor was asking, you're making a trade on Odos. This is how it works, right? You're paying that gas. CowSwap, you're getting this quote, right? The minimum, and that includes the gas fee. So you don't actually have to have ETH in your wallet. When we're talking about how these sorts of actions work with each product. So I wanted to give you the opportunity to speak on how that works from the Carbon DeFi perspective as well.
I mean, you can consider Carbon DeFi to be an intent-based protocol as well. It's just that the complexity of the intent can be arbitrarily high. So rather than rather than choosing to execute a trade at like one specific price or the best price, instead you nominate a geometric sequence of prices that you want to adhere to. You can still do single limit order type stuff, right? And so that is the user saying like, this is exactly the price I will accept. And I think that this is a natural and let's say well organized feature that a healthy market should have. I think that the ability to discover prices with auctions and things is extremely powerful, and I'm really like thankful that we have protocols like Cow Protocol, and even to some extent the like things like 1inch Fusion, right, that are adding this kind of auction system like into the price discovery mechanism, and even allowing for things like partial fills. Like these are very, very important elements. But as we pointed out, the solvers still often need to connect those those auction results, right, or base their bids in that auction on an opportunity that they know that they can exercise. And that means that you need a source of a static price quote somewhere. You can't have everything be an auction. I mean, it would be kind of weird if everything was an auction, because it would mean that the only reason anyone is interacting with anyone else is because they want to take exposure to that thing. And often that's not true, right? In the example that we had with when Alex and I were discussing who is it that is actually losing money on the 12-second block time on Ethereum, and I was arguing that there are two parties that have equal claim to be losing money, and they can't both be right. In that situation, an auction system would actually allow the people, like both of these parties who are claiming injury, to actually negotiate directly with each other and discover a price. And this would make arbitrage obsolete. And in a way, that auction mechanism that CowSwap has, and a few other protocols are working on, in a way, it is looking to capture or eradicate, in some sense, the need for an arbitrageur in the middle. But that auction still needs to be motivated by something, right? And some people may be motivated, and this is what we said about private liquidity earlier. It could just be that people are participating in that auction because they want to buy the token that you're selling. There's nothing wrong with that. But often, there is a much deeper, much greater, broader network of liquidity out there. And the people that are participating in the auction are only doing so because they know that can lay off the bet that they're making straight away. And that is, in essence, part of the thing that I think characterizes an arbitrage trade compared to other things. I know I've spoken hyperbolically before about what is and isn't arbitrage, but I think that everyone would agree that the ability to lay off the risk that you're taking when you're buying a token immediately is a pretty good characterization of an arbitrage. And in order for them to do that, they need to know that they can lay it off. And that's what you need static price quotes for. So, Carbon DeFi is looking to become, let's say, a critical part of this liquidity patchwork, right? It's not looking to like dethrone anything. We don't want to. I would not like to imagine a world where we don't continue to have things like AMMs, or we don't continue to have, CowSwap-like protocols that are facilitating price discovery through auction mechanisms, be it, a batch auction system or a Dutch auction system, whatever it happens to be. But these things are all like necessary components within each other. The solvers on CowSwap require a static price quote if they're planning to perform an arbitrage, and it means that the users on the CowSwap protocol are getting their orders filled more regularly. These things all work together. I don't think that there's a superior option.
Yes, but one of the rules that is enforced within the solver competition is this concept of EBBO, which is similar to MBBO. So basically, it's Ethereum best bid offer, and then the solvers are forced to actually give like the average aggregate of what all the MMs give together, right? So this is like the rule in order to limit this sort of arbitrage from private liquidity that you're saying that, hey, I can, this, let's say, reckless user or not very informed user just place this limit order at this price and they didn't know that it's currently trading at another price. Well, in this case, the auction, this is kind of like where the starting point is. The solvers have to give at least the same as this ABBO price or better. If not, their solution won't rank in comparison to the others. Well, I guess if they all screw up, then the solution never gets.
Yeah, understood. Yeah. The bidding starts at a fair price. Like I pay this, and I'm not. This was. If you thought that I was pointing out a flaw or something,
No. I was more explaining it.
Yeah. I'm just the point. So, and in a way, this is kind of further to my point, is that in order to even generate that fair price, you need someone to quote one, right? And that can't be done via an auction, right? In order to even start the bidding price at something, you need a whole bunch of AMMs to agree on where the bidding should even begin. And so, yeah, I consider these to be, these are all necessary components. And you can't, it shouldn't be anyone's ambition to remove any one of them. And, I think that the niche that I'm trying to fill with the protocols that I'm designing is this static price quoting or predictable price quoting, but price quoting that is commensurate with the user's ambition to sell at a certain price or buy something at a certain price. And that's okay, right? And then there will be people that are like, no, I want to auction this and try and get the best price that I can or something. These are all, equally valid and equally useful players in maintaining a healthy marketplace.
I have something to jump in here with. If everybody used something like Bancor, right, or sorry, Carbon DeFi, and obviously there would be some gaps, right? There would be gaps in liquidity, so price would jump quite drastically between those gaps at times. If that was the only system being used and everybody was quoting their exact price, so it's kind of clear that we still kind of need the constant product or at least concentrated liquidity, in the sense that like people will always be able to get like buy and sell at the current like value instead of having like large jumps between in their trades. Maybe it's not absolutely needed, but this is kind of the way I'm looking at it, is that without like some sort of deep enough liquidity everywhere, then the trading experience for people will be very jagged, right? It'll jump quite quickly.
Yeah, but the market has no obligation to give you that experience, right? Like, and if you think about it on a day-to-day basis, the market doesn't give you that anyway, right? Like despite the depth of Bitcoin's liquidity, it has an extremely jagged price profile. And despite all of the AMMs offering a continuous pricing, it still leaps around. And this is kind of the point that I was making with the PlayStation 5 eBay market piece that I wrote in December of last year. If you buy a plate like the cheapest PlayStation on eBay today, the price will leap to whatever the next best price is, and that's fine. There is literally no requirement, and there has never been a requirement that the price has to move around smoothly. It's in fact some of the volatility that we see today and sort of the profits and motive that drives the market forward is actually fueled by the fact that there is discontinuous pricing, that the market is inherently inefficient, right? This pursuit of efficient markets is a bit of a red herring. What we really want is predictably inefficient markets, right? Or a tolerably inefficient market, because that without that, we're basically get the heat death of finance.
We're at the top of the hour, and I feel like we just now like touched into an entirely new discussion. Does anybody want to? I mean, I'm fine here. right? But if Alex or Matt or Ceazor, if you guys want to add anything to what Mark was saying, or what we could do is really pick back up again with this and talk about, the inefficiencies in the market. Because Mark, I know that you were saying that there's no requirement, but my own take, like, shouldn't this be a goal of ours? To create some sort of, we want there to be an inefficiency, right? But don't we want to give users this experience? Nobody's required, but wouldn't this be an ultimate goal?
You want people to get a price that they're happy with. It doesn't necessarily need to be on a continuum.
Okay.
I would use the word expectation as opposed to requirement. Like, I feel people are expecting that they don't have to be on top of things immediately. Like they can kind of, like, you're right, like Bitcoin moves 3% a day and it doesn't phase us, whereas like TradFi people would be like, this is like giving me a heart attack, right? But like being able to know that like you're not on top of it for a little bit and it's not going to move vastly out of your range with a higher market cap tokens, then you can kind of, you don't have to be so on top of it. So kind of the user experience of expecting there to be always tradable liquidity, like especially on the downside, right? Like if someone sells and you just lose like 40% of your portfolio in that asset, that can be quite a bad experience for people. Whereas if like there's liquidity all the way through that 40%, it can slow down that dump.
But whose responsibility is it? Like, who should be responsible for providing that liquidity and making sure that there is that depth in the market?
Yeah, that's a tough one. Like, I don't believe the community should be the one responsible, but that's
nor
why
the AMM.
But that's why people
they're
are
relying
paying
on them, right?
That's why projects are paying them to provide that liquidity in some ways, giving them incentives or rewards, or like the trading fee shill, right? But at the most of the time, it's like, we'll give you incentives in order to provide this user experience. And then, of course, the chains, they want as much transactions as possible. So they might incentivize it somehow as well through grants and stuff like that.
I feel like the expectations have been created. Or let me put this as a question. Do you think that we as an industry have somewhat created these expectations and allowed them to be seen or, expected to be realistic? Because Ceazor, I giggled when you're like, well, it's expected. I'm like, so is the airdrop. So is 200% APY. And so is, you know what I mean? So it's like, yeah, we all expect all of this stuff, but like, let's be realistic here. How is the industry actually going to move forward? Is it by saying, okay, thanks for buying my token. Now go ahead and provide liquidity. And here I'm going to reward you, right? Like, is this an expectation we actually want users to have?
I wouldn't say we want them, but like, it's kind of like the market or the entire like crypto industry is kind of still in an infancy. So we want to like, there needs to be fireworks in order to attract like the users.
Didn't we have that with DeFi stuff? Okay. All right. I was going fireworks on the opposite side. Okay.
Yeah, I don't mean bad fireworks. I mean like just like good stuff in the sense of like, wow, this stuff is pretty good. I can, make life-changing money. This kind of ideal is still very prominent inside our industry, and trying to like allow people to, encourage people to participate when they otherwise wouldn't be. Like, well, what's the point? Like, I just sit in my like bank account or whatever. I don't know. Like, I definitely think we've gotten out of control.
A longer discussion.
No, yeah, but I think like I was gonna say, I think like Ceazor, I think he touched on it's maybe not so much associated on the participation, but on the on the expectations of reward, but rather on the participation, right? The feeling that you have this access of opportunities to things, products, or opportunities that otherwise in the traditional finance world you're completely locked out of, whether it's because of capital, whether it's because you're not from a country that has access to finance, etc. So this is why it's a conflicting of a lot of people mixed together, and then like things sort of explode because people take advantage of other of good heart people. But it's more the idea that why not? Why shouldn't I be able to provide liquidity as long and this is for me was one of the attractiveness of crypto, right? To the point, as long as I'm fully aware that I'm responsible of my own actions, as Mark said, why shouldn't I take this trade? Maybe I win, maybe I lose. And even touching on the point of the token from when you launch the token, and even if I'm helping a project kind of bootstrap at the beginning, hey, so be it.
Exactly.
Ultimately, most of the people are regardless of, at least in finance, right? They're driven by the expectation of making money. So it's sort of, I don't know why we want to hide it or kind of don't, agree on the fact that everyone is here for that point. Yes, of course, everything is going to change the world and so on. And that's the whole point.
So on.
No, yeah, because this is the whole point. It's insane the amount of access. I'm from Spain, but it's a developed country. I have financial access. I'm not very locked out, but still there are certain levels. So crypto is going to change that. But why not also teach this responsibility of this is markets, and markets don't always move in the direction that you want.
Do Matt and Mark, do you guys want to add anything else? I don't want to keep you for too long.
I couldn't have said that any better. I agree 100% with Alex.
Matt?
Sometimes you're going to make a losing bet, and it's no one's fault.
Yeah, I mean, I would probably agree as well. I guess in general, going back to something that was said earlier with the, I think Mark said AMMs are always a bad idea. I think it's more that a lot of the people providing liquidity don't fully understand that it is often a bad idea. But I think going back to the comparison to a straddle where you're collecting a premium and the premium is based on the volume could make that premium much lower than it should be, but it could also make it much higher, right? So sometimes it's you're getting a really great deal and sometimes you're getting a bad deal, and knowing the actual mechanics there and actually figuring out if it's a good or bad deal is probably, well, I'll say definitely not done enough when people are entering these positions. But I think in many cases they remain a good option for people if they do know what they're doing.
I guess we'll go ahead and call it now. Thank you guys so much. It kind of went off into a few different topics, but I really enjoyed the conversation. I know that I have more questions because because we went into a few different areas, right? So maybe we can touch on them a little bit more next week or one of the upcoming calls. We are here live streaming with everyone every Wednesday at 4 p.m. UTC. Alex and Matt, anytime you guys would like to join, would love to have both of you. Thank you so much for joining us today. Really enjoyed having you both. Mark and Ceazor and Josh are here with us every Wednesday. Thank you guys. I know Josh had to ditch, but had to leave early. But thank you to the three of you also. And we've got, almost 1,500 live viewers right now. So you guys are all awesome. Appreciate all of you as well. I put everybody's information there in the comments, Twitter handles, websites, and things of that sort, the bios for all of our speakers, everybody up here on the panel. So please reach out if you have any questions. They can all be reached directly, as myself as well. So thank you guys again. I appreciate you being here.
Thank you for hosting.
Thanks.
Yes, thanks for having us.
Thank you guys. We'll see you next Wednesday.
Bye.
Cheers.
See ya.
Bye-bye.
Cheers.